often see clients who own businesses without partners. They're the sole owners, building their business from the ground up. But without a business partner, how do we set up a buy-sell agreement? In other words, how can we secure a buyer for the buy-sell when there's only a seller? The reality is, without a buyer in place, the owner's successors could face a serious risk. The business may have to be sold quickly, potentially during a down economy, or worse, a buyer may not even be available. It's a scenario that could mean significant loss of value for the business owner's heirs and family. So how do we solve this? Before we get started, make sure to hit that subscribe button and give this video a thumbs up. Doing so helps us reach more professionals like you and ensures you don't miss out on valuable content like this in the future. Independent insurance professionals, if you're ready to work with a forward-thinking and industry-leading independent brokerage firm, then you need to check out the description below. Click the link to take a tour of our agency dashboard. There, you can explore all the helpful quoting, illustration, and marketing tools we provide to our contracted agents at no cost. You'll also find information on the 50+ insurance carriers we partner with for life, long-term care, annuity, and disability income products, as well as details about the advanced markets we specialize in. For those of you who connect with us, you'll receive an exclusive invitation to join our 5-minute live streams, where we share actionable insurance concepts to market to your clients. Don't miss out. There's a wealth of valuable information we pass along to our agents. Now let's dive in. A one-way buy-sell agreement could be the answer. This type of agreement involves the business owner and an outside party who may not currently own any shares in the company, but has the potential to become the buyer. This setup provides a predetermined plan for the business in the event of an unexpected situation, ensuring the owner's hard work doesn't go to waste and their family has a clear path forward. So who could step in as the buyer? The most common choices include a competitor, a private equity group, or sometimes even a key employee. An employee, particularly one who's critical to the business, could be an ideal candidate. With time, they might even be awarded in the business as a compensation, which would naturally lead to a traditional buy-sell agreement. But if equity transfer isn't an option right now, a one-way buy-sell can ensure they have a pathway to ownership when certain events arise. Now, what are those key events that typically trigger a one-way buy-sell? These agreements often cover situations like the death of an owner, the disability of an owner, divorce, or even bankruptcy. With these potential events outlined, both the business owner and the prospective buyer, whether it's a competitor, an investor, or a key employee, have a clear, actionable path for the business's future. Here's how it works when the intended successor of the company is a key employee. The chosen successor, or key employee, purchases and owns a permanent life insurance policy on the business owner's life. They are also the policy's beneficiary. Each year, the business provides a bonus to the employee to cover the life insurance premiums. It is important to note that the bonus payments may be tax deductible to the corporation when they are paid, and that they will be included as income to the employee, which of course results in additional tax liability to the key person. The company can choose to double bonus the employee, which is the equivalent of premium plus tax expected, making the process smoother on the employee by covering the tax liability. Determining the business's value is a crucial part of the process. The valuation not only sets the insurance policy amount, but also establishes a fixed value that may be used for estate tax purposes. This clarity helps eliminate potential conflicts over the business's worth and reduces uncertainty during the transfer process. It is recommended to use a valuation company to obtain this crucial component to the buy-sell arrangement. Most insurance companies will offer their assistance in reviewing financials in order to obtain a soft business valuation. However, insurance professionals need to be cautious when basing the life insurance agreement on these figures solely, as they may not be able to hold up in a court of law. To solve this issue, Fortress Brokerage Solutions works with a group which offers a no cost to the company hard business valuation. We can also use insurance carrier services to review existing buy-sell agreements to identify enhancements or recommendations for possibly out-of-date documentation. To learn more about this unique offering, contact us by phone or email us at info@fortressbrokerage.com. Now, let's go over some key benefits. Life insurance proceeds are generally income tax-free for the beneficiary. The business's bonus payments for premiums may be tax deductible, providing tax efficiency. The policy doesn't increase the business's value or expose it to corporate AMT. And since the business isn't directly involved, family attribution rules don't apply, providing flexibility. Additionally, if permanent insurance is used, the policy's cash value may be accessed to fund a buyout during the business owner's lifetime, helping with retirement or early exit plans. Of course, there are some considerations to keep in mind. The key employee will need to recognize the bonus as taxable income, and also, since the key employee owns the policy, its cash value becomes part of their estate if they predecease the business owner. And while the policy's cash values can be accessed, this will reduce the death benefit, potentially impacting the buy-sell agreement's funding. Let's look at a quick example. Michael Evans, the sole owner of Evans Designs, decided on a one-way buy-sell agreement with his longtime employee, Judy Smith, as the successor. They set up a $5 million life insurance policy on Michael's life, with Judy as the owner and beneficiary. Michael's business provides Judy with a bonus to cover the $185,962 annual premium. Over time, the policy builds cash value, allowing Judy to start the buyout during Michael's lifetime, providing Michael with retirement income. Following Michael's passing, Judy uses the remaining insurance proceeds to finalize the purchase of the company. This one-way buy-sell arrangement is a practical, tax-efficient solution for solo business owners. It ensures business continuity, provides a clear pathway to ownership for a trusted successor, and protects the owner's legacy. We have a free marketing piece that we are giving away that goes over this one-way buy-sell case study. It takes a deeper dive into the Michael Evans and Judy Smith agreement and why they set up their policy in the format in which they chose. You can access this case study's documentation by clicking on the link in the description. Fortress Brokerage Solutions is an insurance brokerage firm designed to empower independent agents. We specialize in business insurance solutions tailored to meet a variety of clients' needs. Whether you're a seasoned agent in the business insurance sector or new to advanced planning techniques, Fortress Brokerage Solutions is here to help. Contact us today to learn how we can help you exceed your insurance sales goals this year.